Hello, friend. If you are interested in multifamily property investing on the south side of Chicago, you're going to want to stick around with this video because I'm going deep into the numbers, comparing all the different neighborhoods on the far south side of Chicago in terms of pretty much any metric that a real estate investor could want. So, in terms of price paid, in terms of the rental revenue coming in, cap rates, 1% rule, all kinds of different things along the way, such as that. This is specifically 3 and 4 unit properties, and it's also the far south side. So the south side of Chicago is just so massive that I had to divide the south side into two separate sets of analysis. So there's another video that handles sort of the north side of the south side, and then this one is the far south side, and I'll show you on a map specifically the area that I'm talking about here in a minute. If this is your first time meeting me, my name is Jake Lyons. I am a real estate agent with Berkshire Hathaway here in the Chicago area. I'm also the owner of the ChicagoHomeSource.com. Working with people on these small multifamily investments is arguably my favorite part of the whole job. It's what got me interested in real estate to begin with, coming over from a financial advising background. The reason I like the 2 to 4 unit space so much is because it allows you the opportunity to get into a actual revenue generating asset, but still be able to take advantage of the same types of financing that you can buy like a house or a condo with. Anything 5 units and above, I'm sure many of you out there already know, but anything 5 units and above is suddenly considered a commercial property, meaning you now you have to get a commercial loan, commercial underwriting. You're essentially buying a business. Whereas anything 4 units from 1 to 4 units is still considered a residential property. So you can get your conventional loan, an FHA, a VA, and other programs like that out there. So it's enough on that so far. I'm going to go show you on a map the exact area that we're talking about. Just in case this doesn't already look familiar to you, this is a map of Chicago. A color outline of each of the 77 community areas of Chicago. You hear a lot of people say that Chicago has 77 neighborhoods. Chicago probably has more like a couple hundred neighborhoods, but they are all sort of comprised in these 77 general community areas. So this is what I did in the last one. So I've separated these into north, which is pretty much, these neighborhoods up here, northwest, west, kind of this area in here, southwest. And then I did south side, and then the far south side, which is going to be this area here, which is what this video is about. Zooming in just a little bit more just to kind of, either a review, or if this is your first time coming across the far south side of Chicago, this is what we're focusing on here. So anything here, Auburn Gresham, Greater Grand Crossing is here, South Shore, Avalon Park. This little triangle dude right here is Burnside, Calumet Heights, South Chicago right here, the neighborhood South Chicago. East Side over here, the aptly named East Side because it is on the east side. You see that? Hegewisch. I don't know if I'm actually saying that right. Hegewisch. I think that's how you say it. South Deering is right here. Pretty big area. Riverdale is down here, the very south end, before you start getting into some of the south suburbs. West Pullman is right here. Morgan Park is actually considered southwest for the sake of this, so that won't be in this area, but in case you're curious, Beverly is right here. Beverly's a pretty popular area. Mount Greenwood. But anyway, Roseland is going to be in this analysis. Here's Washington Heights is right here, and then back to Auburn Gresham. So that's the area that we're focusing on. Let's get into some of these numbers. All right, I figure a good place to start is by talking about how much money it actually is going to cost you on average to get into one of these types of properties on the far south side of Chicago. So what we're looking at here, this is going to be the same general format across all these graphs that I'm going over. The neighborhood name is down here along the bottom, and then the blue column is the average sold price for 3-unit buildings in that neighborhood over the past year as of about midway through 2021. So midway through 2021 back through midway through 2020, that 12-month period, the average sold price of 3-unit buildings in these areas. And then the red column is 4-unit buildings, the average closed price of 4-unit buildings in each of these neighborhoods. And then the neighborhoods that you see that don't have any columns with them, those simply did not have enough 3 or 4-unit properties to be able to even really have any estimates on, or any data on, I should say. Still have them here because they're still a part of the area, and they will come into play on other graphs. But for the sake of this, they just not a part of this discussion. So what you see here, I would just call a quick attention to the fact that the difference between 4 and 3-unit buildings is not much in the areas that have both. This is kind of something that you'll see start to come into play in the later, as I get into some more complex metrics a little bit later. Is you would expect, since you're bringing on a whole other stream of income, you would expect to see the cost of a 4-unit be significantly higher than a 3-unit, but that's just simply not what you see here. And in some cases, you even see the average 3-unit being more than the average 4-unit. So just file that away for now. Anywhere from in the far south side, you'll see anything from, looks like the South Chicago neighborhood looks like the least expensive entry point, a little less than 200,000 either way to get into a 3 or 4-unit property. And then South Shore looks like that is the going to be the top end of the far south side. You'll need to come up with about 350 to 400,000 to get into one of these properties there. Next, let's see how these property prices relate to the amount of rental income that you can expect from each unit. All right, this mess of a graph here is representing the numbers for the amount of rent that you can expect to see in each of these different areas. So when what we're looking at here is blue columns represent the average rented price for 1-bed units. Red columns are the average rented price for 2-bed units. Yellow is for 3-bed units. Green is for 4-bedroom units. And then orange is just the overall average for all units that were rented in that area over the past year. So just all units that were rented, for regardless of bedroom or the price or whatever, just throw those all in the bucket, take the average of them, and that is what that orange bar represents. So for the most part, you see here like just patterns that you would expect to see. 4 beds are more than 3, 3 is more than 2, et cetera, et cetera. I don't have anything for studios in this analysis, but I can pull that up later if you really want me to. Just reach out. But so you would expect to see that pattern, which indeed, for the most part, Pullman, and you see some outliers here and there, but for the most part, that is what we're seeing. And you can also just refer back to the graph before, just to see how these rents kind of relate to the price of the property. And we'll get deeper into that in the that's kind of what the next couple of graphs are all about. But you can see the average kind of hovers anywhere from, it's pretty consistent across the board all over the far south side, really. But South Chicago looks like they're close to the lowest in terms of this average overall, about 1,100 or so, versus it looks like Hegewisch is probably the highest, about 1700 on average. Looks like the 4-bed units there are making that average number go up quite a bit. One note on this graph that I do want to call attention to is that for all of the metrics that I'm about to get into, like the cap rate and the 1% rule, which I'll explain here shortly, and things like that, I'm taking the average overall rents for all of those. So that's why, like if I didn't do it that way, then I would have to, start coming up with all these different scenarios of like, well, if the building that you're getting has 3 units, that's a 4-bed and a 2-bed and a 1-bed. It's going to be different than 3 beds and that kind of stuff. In order just for everyone's sanity, I'm just using the overall average rent and applying that to the average sold price, and that's how I'm working this for the rest of this. So just keep that in mind, and just keep in mind that in the real world, and as you're looking at individual properties, these are all going to be a case by case basis, property by property. It's not, each property isn't necessarily going to fit all the patterns that we're talking about here. The goal of this whole exercise is just kind of have like a 10,000 foot overview, and sort of an apples to apples comparison of what's going on in these different neighborhoods using similar metrics across the board. So that's the goal, and hopefully you guys can follow along with that. So that's it for this slide. Feel free to pause it if you want to take it in any further, but in the absence of that, let's move on to what is called the 1% rule. All right, this graph is going over the 1% rule, or the 1% guideline, 1% quotient, whatever you want to call it. If you spent much time in Bigger Pockets, listening to any Bigger Pockets podcasts, or on their website and their forums, or anything that they've ever done, you probably heard somebody at least reference the 1% rule. They're the ones who, as far as I know, at least popularized this term, if not coined it. And basically what the 1% rule does is it's just a way of kind of comparing the amount of rent that a building is getting to the amount that the building costs. So it's just simply, if you have $100,000 building and it's bringing in $1,000 worth of rent, then you have met the 1% rule, according to these guidelines. So that's what's going on here. So again, for this, I'm taking the average overall rents for the area, and then multiplying that by however many units I'm talking about, and then dividing that by the average cost of that building with that many units in it. I think that made sense enough. So this is what we're looking at here. So for blue is the 3-unit properties, red is the 4-unit properties, and so pretty much every area here at least meets this 1% threshold. You see South Chicago is kind of leading the pack in terms of the bang for the buck here. And it's important to note that this is just a comparison metric. It's one kind of tool in the toolkit to be able to see how the rent you're able to bring in relates to the cost that you're paying for the property, but it's definitely not the only metric that matters by any means. Just because, for example, like South Chicago, you might see, okay, well, is 2.7% on the 1% rule. So that seems really, really good. But what you might not know, and I'm not saying that this is the case, I haven't looked into these numbers specifically, but maybe the property taxes are higher in that area. Maybe the renovation costs are higher in that area for some reason. Maybe utilities are higher. Maybe the vacancy rates are higher, and the turnover tends to be longer between tenants. And those kinds of things will make the actual return on your investment go down. So not that this is definitely an important metric to consider, and kind of as a nice quick way of comparing things, but it's not the end all be all by any means. But one thing that you can start to see in reference to what I was talking about earlier, how the 4-unit properties are not as much more than the 3-unit properties as you would think they would be. is you start to see that play out here by just kind of how much more bang for the buck you're getting for the 4-unit properties than you are the 3-unit properties. So all these for all the neighborhoods that do have 3 and 4-unit properties, you see that all the red bars are higher. And that just means, that is exactly how you would think that would play out based on the cost of the 4 units not being that much more, but you being able to bring on a whole nother stream of income there. So, you can see like South Shore looks like South Shore and Chicago Lawn are coming up right about that 1%. South Chicago is leading the pack almost, 1.5 to 2.5%. Then everybody else is kind of in between. I don't need to spend a whole lot of time on this one. You can, take it in for yourself there. But I just thought that this would be a fun way to compare how the rents are shaping up to the cost. So I'm going to move on to a metric that you might be a little bit more familiar with, and that is cap rates. If you've spent much time in the real estate investing community, or talking to people about real estate investing or anything along those lines, or if you've been a real estate investor yourself, you've probably heard somebody say something along the lines of, I'm looking for a 6 cap, or I'm looking for a 10 cap, or I sold my underperforming 2 cap the other week, or something like that. When people say that, this is the measurement that they're talking about. So what cap rate is it measures the annual net operating income of an asset divided by the value of that property or of that asset. So it's a little different. It's a little more involved than what we just talked about, which was just the raw, like, gross monthly income divided by the the value of the property. This takes into account your income, your expenses, the difference between that, and then how that relates to the value of the property. So for this, I had to my calculations on this are a little bit more art than science. I had to look into seeing what the average expenses were that I see out in the field. So, like, for example, I did 8% for vacancy, 8% for management fees, 10% combined for maintenance and capital expenditures. I had a multiplier in there for property taxes, utilities, insurance, things like that. So that's all highly variable stuff. That's all gonna, in the real world, highly depend on the individual property. But for the sake of the conversations we're having here, it's at least consistent across the board, and therefore I believe still a valuable way to compare these different areas. So with that all being said, this is what the cap rates for 3 and 4 unit properties in these areas shape out to look like. On the low end, you see, Chicago Lawn for a 3 bed there, or 3 unit, is coming in about a 7 cap. And then at the very high end, you see South Chicago, which you would expect to be high in this as well, since it was high in the 1% rule, almost coming in at 4 units coming in at almost a 22 cap, which is pretty crazy. And another trend that you see a lot is the areas where the price points are at their lowest also tend to be higher cap rates, higher on the 1%. The difference that you're getting between the rents in that area and the price to buy in that area just tends to be a little bit more skewed. And just the numbers just kind of speak for themselves. The supply, demand, all kinds of different factors going into that. But that's just how we see that play out more often than not. But yeah, so these are the different cap rates. Almost all the neighborhoods that we can talk about that have these types of properties are at least in the mid to high single digits, if not eclipsing double digits. So that's pretty solid, at least in terms of just these raw numbers. Again, this isn't everything. This isn't Okay, please do your due diligence on each individual property you see in the area and the individual block that it's on and all that kind of stuff. There's so much more to it than just this, but again, this is just a nice a nice overview of what's going on in these areas. So, any questions on this? Just leave it in the comments or reach out to me. Let's move on to some more long-term metrics now. So everything we've talked about so far is they've all been very kind of here and now metrics, right? They've all been kind of these upfront, how much money can I make today if I bought a property in this neighborhood types of considerations. And obviously those are very important. Those are the first things that you want to make sure that you're getting right. After all, you want to make sure you're making money. You definitely don't want to lose money. If you're losing money on a property every month, odds are you're not going to be in a very advantageous position to see any long-term growth and any other kind of metrics. But assuming that you do get that part right and you have a stable income generating asset, I would say arguably the next most important, or maybe even the most important thing, is the appreciation of that asset over time. So what we talked about so far is how you can build an income stream, but on this graph, we're talking about how you can actually build wealth and equity over time. When you look back in, 5, 10, 20 years from now, and you see, wow, this building I bought is worth like this much, way more than what I paid for it. And I've just been having tenants, pay, earn this equity for me and all that kind of stuff. That's when you can turn around and say, okay, you have a lot of options now. You can cash out, refinance. You can take out a relock, or you can sell it at a huge profit. You can do any number of things with it at that point. So that's the goal there, and so that's why appreciation rates, growth rates in these different areas is very important to consider, and that's what we're talking about now. So for the blue columns in this are going to represent the annual growth rate, the average annual growth rate for 2 to 4 unit properties in these different areas over the last 5 years. So average over the last 5 years. And then the red is just over the past year. So just the past 12 months as of the collection of this data. Okay, so there's some pretty wild growth rates going on down in the far south side. You've seen a lot of development, a lot of reinvestment and investment, new investment. You see the city partnering with investors to go in and sort of clean up some of these areas that were sort of on the more dilapidated side. Some of them, that's not the case everywhere, obviously, but there's certainly some of that going on. And you see that in the form of these crazy growth rates, right? So, property, in some of these areas, properties that you might have been able to pick up for a few bucks in a signature a few years ago, it's getting, people have gone in there and they fixed up those properties, and now they're going for, hundreds of thousands of dollars, thousands of percents more than what they paid for them. And that's why you're seeing these growth rates. And these growth rates, by the way, aren't even including like foreclosures and short sales and things like that. These are all just traditional sales. So, with that said, that doesn't necessarily mean that you're going to go in and buy a fully renovated new building in Auburn and then expect that building's value to go up 20% each year over year. So it don't necessarily jump to apply that to individual properties, but this is just an indication of what's going on a broader scale in these areas, if that makes sense. But you would expect to see some solid appreciation in these areas. There's nobody has a crystal ball. I make no predictions on, I don't, those upfront metrics should definitely be dealt with first. You want to make sure that you have a cash flowing asset, because you don't want to just bank on future appreciation and speculation, because nobody knows what's going to happen. But the best predictor of future performance is looking at past performance, and that's what we're looking at right now. And these numbers look pretty good. 30, you see like West Pullman over here getting 40% year over year over the past 5 years. That's crazy. The East Side, 35%. Roseland is 30, these are just gaudy, pretty crazy numbers. So take that for what you will. This is what the numbers say. But yeah, so that's pretty much my the end of my spiel on the growth rates. Feel free to reach out if you want me to dig deeper into how specific properties have fared over time, specific blocks even, and that kind of thing. I can get really granular with this stuff, but this is how these general areas have been relating to each other. And that concludes my discussion on the far south side of Chicago in terms of these multifamily 3 and 4 unit properties. Hopefully, you got something out of this. Hopefully, it was very helpful and educational. If you found those things to be true, I would hope that you would like this video, comment, subscribe, share it with a friend. Just do the thing that indicates that you like this and want some more of it. Again, my name is Jake Lyons, realtor with Berkshire Hathaway here in the Chicago area. I have a lot more resources on multifamily properties than just this. I've done similar videos on the top half of the south side, the west side, the northwest side, and the north side. I also have sort of a meta analysis of just comparing all these different areas to each other. So that one's kind of some inception level craziness that I think is pretty helpful. And I also have what I think is the best resource available to anyone who's looking for multifamily properties in Chicago right now is a daily newsletter that goes out that hand analyzes each new property within just a day or two of it coming to the market. And we analyze it in terms of price, potential revenue, cap rate, all kinds of different things like that. So if you're really serious about multifamily, it's free. Jump on that. I don't think you're going to find a more helpful newsletter to be on anywhere. So that's it for me, and look forward to seeing you in the next one. Thanks.